I'm going to start with a brief introduction of ourselves. I founded Lyft because after working in multi-billion private equity firms all my career and investing in the stock market since I was 14, I was convinced that there was a great opportunity to invest in public markets, combining the best elements of private equity with value investing. That's our differential approach. We use that previous experience in private equity as buyers and owners of businesses with our experience as value investors in public markets. With this mindset, we invest in equities and corporate bonds on a global basis, looking for superior risk-adjusted returns along the capital structure of companies in sectors we know well. In the 5 years we have been investing our money with this strategy, we realized that there are 4 investment themes on which we have achieved our best returns. These are forgotten holdings, contrarian stocks, which is more like buying the junk and selling the antique, investing in listed companies owned by private equity, and in a more residual part, following activist investors. But the best of the best returns come from combining several of them. For example, a forgotten holding trading with a significant discount to its intrinsic value together with an activist pushing for action match very well. Another one is a contrarian stock suffering short-term issues on which the main shareholder is a private equity, give us home comfort that action will be taken to address those short-term issues. So today, I'm going to present one idea that meets both criteria, which is a contrarian stock owned, publicly listed, but owned by private equity. And this company is Talgo. Talgo is a manufacturer of high-speed trains. It is a listed company, but private equity owned, and which does not count with the favorable market. It's a top 3 investment in our portfolio. We have an average purchase price of 4.4 euros per share, and we believe that this company worth at least 8 euros per share. And we have the benefit to have been monitoring Talgo since more than 20 years ago. My first contact with the company was in this picture, as customer of one of these products. Also, this is a company that we have been following in my previous experience in private equity because it was a private company. And this was one of the companies that has been always on the target list. Okay. Now, it has been listed for almost 3 years. And we believe that most of the market still don't understand this company business. Now let me try to explain how is the business. Talgo is one of the few leading manufacturers of very high-speed trains. Approximately 60% of the business is selling rolling stock, and 40% of the business is providing maintenance services and related equipment. I would like to highlight the attractiveness of this maintenance business because it has very high margins, it has contracts which have an average of 16 years length, it has a very good cash flow profile, and with the 16 backlog, the company will grow this part of the business at circa 10% per annum in the next 4 years. And it's a company also with a long history. It has been for more than 75 years. Since 2006, it has been owned by private equity, which took the company public in 2015. But they still remain as the main shareholders of the company. It has an international presence. And let me talk to you about, in terms of products, what's their positioning. This is a company which is mainly focused on the very high speed and high speed trains, which, as you can see in that pyramid, it's the narrow part of the market, but it's very profitable. There are less competition, and there are strong barriers to entry in that market. However, as I mentioned, it's a segment very narrow with less volume and less tenders. And for that reason, the company took the decision several years ago to develop a new regional commuter train to increase its addressable market. In terms of technology, it has some differentiated factors, which the key message is that they can provide to the customer certain advantages in CapEx and also in maintenance costs that are differential to competitors. About the industry, this is a growing industry. It's a growing industry and expected to grow at between 2 and 3% per annum. There are several long-term trends that favor this growth, and at the same time, it's also an industry under consolidation. And there, in the segment that Talgo is focused, which is the very high-speed segment, there are only 6 players left in the world. Okay. As I mentioned before, this company, the main shareholders of the company are private equity firms, and also the royal family who founded the company. As part of our 4 investment themes we mentioned before, we like to co-invest in private equity. We like to co-invest with private equity in listed companies because private equity exercise control over management and bring financial discipline in the decision-taking process. And this is something very key in this industry and in many other industries which are project-related. So, private equity owner of this company has shown that they are very disciplined in the way the company bids, in the way the company manages the cash flow, working capital, etc. Also, we like that they will look to maximize value at their exit. And if the market does not recognize the value, they will look for an industrial buyer who recognizes the value. Also, we have been in their shoes. So we understand their motivations and we share their goals. Also, I wanted to highlight the important insider activity has been in this stock. Whether it was the private equity firms, their partners, and also the management have been actively buying shares during the last years at prices that most of them are above the current market price. In terms of capital allocation, the company last year they conducted a buyback and most likely will conduct a buyback this year. Then you would ask, why this company with all this strength, it's a contrarian investment? Because it's a company which has underperformed the market. The first reason is it's a broken IPO. It went public at 9.25 euros per share, which was the low part of the IPO range. It went down 9% the first day, and from there it has been going down and underperforming. There are several reasons of this underperformance. First one, when it IPO, it was expensive valuation. Second, they have suffered some cancellation of contracts, delays, and also the company is not the best communicator in the world. It's a clear and unloved stock, barely understood by the market, and we believe that this negative sentiment is reaching to a turning point. Another reason of underperformance, it has been their lack of recurrent orders. And as you can see, as you can see in 2015, 2016, order intake was very low, which affected the way they consume their backlog, and this, with a time lag effect, impacted the revenues in 2017 and will impact the revenues in 2018. However, now the company, after the last big order intake of last year, it has a large backlog, which is eight times last 12 month revenues. It has expanded its addressable market because of the launching of new products, and also its workforce, its sales force. And then we have a clear visibility on the next coming years. And this is because the company is actually bidding for a pipeline of 8.5 billion for the next 2 years, and is also providing a guidance of 1.3 book-to-bill ratio. Another reason of underperformance has been the increase in debt. This company has increased its debt since it went public in 2015, has been increasing its debt to reach a point here in mid-June last year. So people don't understand the cycle and the cash cycle of the business. This is a business when sometimes the cash cycle takes 3 to 4 years. Also, for us, we take a longer view, and we believe the company has understood the company and has raised a lot of fear about the increase in debt, which today, after reporting the last earnings, the net debt has significantly decreased based on the free cash flow generation generated last year and the cash flow generation that we create over this year. Another reason of underperformance has been the risk of margin erosion. Many people of the investment community believe Talgo margins will convert to peer average, which are significantly lower. We believe EBIT margins will be lower, as shown in the chart, passing from the 18% to the 15%, because some new contracts are less profitable, particularly the very high-speed contract awarded in Spain last year. Also, we believe the different business mix of the company will impact margins. However, there are several structural reasons for why Talgo margins are higher than competitors. The first one is that peers are not comparable. Talgo is focused on the most profitable segment of the industry, which also has the strongest barrier to entry. Second, Talgo has an asset-light model with an optimized manufacturing. Third, it has a lean personnel structure compared to large conglomerates with costly overheads and legacy costs. And four, it has an ownership with financial discipline and very selective bidding for contracts. Now let's move to projections. We are long-term investors, so when we look at companies, we like to see how the company will look like in 4 years' time under 3 different scenarios. So when we build our models, we create base case, we create an Excel case, and we create a downside case for a 4-year horizon, at least. So in terms of the base case, we see a 63% upside from the current share price, which is €8 per share. As shown here, and something that we bring from private equity, we like to divide how the upside is made from different parts. So the first one is, and the most significant one, is EBIT growth. We have to take into account that this company is coming from a 2017 depressed EBIT. So we see a significant growth here, but most of this growth is just only taking into account the execution of the current backlog, going contract by contract and see what's the margin of those contracts, and taking into account that the company will in the future achieve the same order intake that the company has achieved during the last 10 years. Also, we have the rating, and this is the rating evaluation, because we have been very conservative and take an approach of 9 times EBIT, enterprise value EBIT of the last 12 months, compared to the 10 times that it's trading right now. Remember, it's also under a depressed EBIT number. And then the last is the leverage of the company, which mainly is the cashing in from the Saudi Arabia contract and the investment in working capital to growth and to execute the backlog they currently have. We also provide a few numbers, or the way that we see the different cases, the downside and the upside case. I would say that the key takeaway of this slide is that if the current price right now is around here, we have very limited downside risk compared to the target price on our base case, which is €8, and we have enough upside if some good news are coming in the future. Also, we have made some sensitivities on certain risks and upsides that are not contemplated in any of our cases. So on the risk side, the main weakness of this company is that it has few customers and very concentrated. So we wanted to see the impact of some problems on those customers. We have here from renegotiation of maintenance contracts to also to the point that its main trade receivables, which is Saudi Arabia, they don't get collected. On the upside, we have one which is coming next year, which is there is a 2.7 billion contract in the UK for the high-speed rail, on which Talgo has been one of the 5 companies selected to bid for this contract. Second is what happens if this company is acquired by an industrial player in an industry which is under consolidation. And the third one is what happens if they finally sell some coaches into India, which is a market they have been for a long time, and which they have a differentiated technology that can provide them an advantage for certain routes of the country, but in India it takes time to get awarded. In terms of comparable companies, there are not many, and some of the listed companies are not comparable, or they are part of a larger conglomerate, but we wanted to provide them a few numbers here. I would say that, again, key message is this is an undervalued company despite having the best operating metrics in the industry and despite having also a growth for the next coming years, which is supported by the 16 backlog. As you probably have noticed, we put a lot of effort on not losing money. And in our analysis of the downside risk, that's key. That's something also that comes from our private equity experience. As a private equity, most of the times you try to avoid downside. So we also create what's the liquidation value of Talgo if the company gets liquidated. So if we go business by business and we start with the maintenance business, taking into account the 2.3 billion backlog, which, as I said before, is a high-quality business with high margins, average length of 16 years, and we put 11 times enterprise value EBIT multiple, we get a 3.6 euro per share. If we add that only the manufacturing part, which is rolling stock, which currently a company has in the backlog, they execute it, that would give us 0.6 euros per share approximately. And if we take the working capital of the company as of December of 2017, we get almost 1 euro. In total, 5.2 euros. If you deduct the adjusted net debt, we add to the reported net debt some elements. We deduct 0.4 and we get to 4.8 euros per share. So if under the current share price, or at least when this presentation was made, of 4.88, that provides limited downside and great margin of safety given liquidation value and also our downside case scenario. To sum up, this is a leading company in a growing industry under consolidation. It's an attractive business model with a differentiated technology, and it has a strong ownership with financial discipline, and it has limited downside with a very attractive upside potential. And with that, open to questions.
Thank you very much. Any questions for Francisco? Nobody wants to get on a train?
People is very hungry.
Oh, yeah.
Yes, just one question. Thank you for the presentation. What is, because everybody understands about the typical product of Talgo, it is the typical mid-speed, high speed, etc. But on top of the contracts in very high speed with the Spanish government and Medina Meca and Kazakhstan is more mid-speed, what kind of differentiating factors do you think Talgo has against Alstom? Because I think Alstom is bigger, has more political influence, better financial healthy, is healthier in terms of net debt. So how can this company compete versus the very high speed business with Alstom, for example?
Okay. And just specific to very high speed? Okay. Yeah, I mean, it's their strength. Okay, so let's talk about first on the commercial development side. Okay, and for me, the advantage is, yes, it's a smaller company. It doesn't maybe have the same lobby push that may have Alstom and Siemens, but the company has a very advantage in terms of value proposition in cost to the clients. So for a railway operator, in terms of capex and in terms of maintenance costs, they are more competitor. The product is more competitor, and that we have seen in the last two bids the company won, which it was in Saudi Arabia and in Spain. And when you compare the offer price and maintenance cost, it was lower. So that's the advantage. Obviously, I don't see Talgo winning a contract in France, in Germany. No, I don't think so. But in countries where people are looking at the cost advantage and the operating costs, I see Talgo has a chance. And then on the second part, which is why do they have or where they may have better EBIT margins, is because we all know, and I don't know if some of you have worked or have you seen in large conglomerates, how there are multiple layers of overheads, of loose decision-making process, etc. And here we have a linear structure, which also has a private equity owner, which is a very important financial discipline. And this is very important because we have discussed with people and experts in the industry. And what they say, you know, you lose a lot of margin when you bid for everything and you don't win. Because bidding for a contract, it's a lot of amount of money in terms of everything, preparation of the bid, etc., lobby, whatever. So you have to be very selective where you can win, and win more than you lose. So that's one of the advantages.
Thank you, it's very interesting. Can you elaborate a little bit on the underlying economics of the business in terms of like, are these the kind of guys who are like selling like Rolls-Royce, his product as a loss or at a loss or just breaking even and, you know, getting all the juice on maintenance contracts, or they are making money up front?
Could you repeat the question because I don't hear it very well?
Sure.
Understand.
So basically, are these guys selling like the main product at a loss or just breaking even and making all the money like on the maintenance and aftermarket, or like Rolls-Royce, for example, or they are also making money up front?
No. They say, they don't disclose numbers, company, but you can check when you see also some of their bids in some certain contracts. So they win money in both sides, the manufacturing of the rolling stock and the maintenance. Okay? The margin is a little bit different, but the margin of the rolling stock business is still good. It's above 10%. Okay? So it's still good business.
And a second question, if you allow me. Basically, can you give some light on cancellations in the past of the backlog that happened? Or?
Yes. The main cancellation was a project that the company got awarded just a few months before the IPO, and it was I think it was March 2015. It went IPO in May 2015, and it was cancelled in July 2015. So it was cancelled by Saudi Arabia after a few months that it was awarded, a little bit related also with oil price, etc., budget constraints, etc. And this is a project that is coming actually right now on the pipeline for the next year. That's the project, at least that I know, that I'm aware that it was cancelled. Okay. The other ones have been a lot of delays. This is project management, so we all have to know that in this type of projects you also have some delays, and moreover when you deal with states.
Anybody else?